Hello friends, welcome back to our video. In this video, we'll be talking about the concepts which would be applicable while preparing and presenting the profit and loss account. We have talked about a few accounting principles which would be applicable while recording the transactions. Out of those principles, 5 principles would be important for us while we are preparing the profit and loss account. So let's see what those concepts are. The first is the realization principle. This talks about the timing when the revenue is said to be recorded in our books of accounts. Right? It says that the revenue is recognized. The revenue is recognized when the goods are transferred or the risks and rewards related to these are transferred, which means at the time of transfer of the ownership, we would say that the realization has happened or the revenue has been recognized in our books of accounts. Let's see this by way of a few examples. Suppose if we talk about the sale of a car, when do you think that the car dealer assumes that the car has been sold? When the car moves out of the showroom, or when the payment is made, or what would be the timing for recognizing the revenue in case of sale of a car? We know that the car sale would happen only when the documents are registered in the name of the owner. So the moment these documents are registered or signed or agreement is entered between the dealer and the buyer, that is the point where the revenue would be assumed to be realized in the books of accounts of the seller, right? Similarly, if we consider an example wherein a laptop has been sold which is being sent through courier. So do you think when the laptop has been given to the courier company, that would be treated as a sale? In this case, what would happen is it would be the timing where the courier guys has transferred or handed over this laptop to the buyer. Because what happens is during the transit, if something happens, it is not the buyer who is going to bear the risks. It would be the seller. So the sale is not completed till the document, or sorry, till the item is delivered to the buyer. So anything if it is sold by way of courier, then it would be treated as a sale or the revenue is recognized only when the document is handed over by the courier guy to the buyer, right? In case of a plumbing service, what happens? It would be the time when the plumber has done all his job and get it verified by you. Verification happens, that is the time when you are liable to pay to the plumber the amount for the service provided by him. So this principle says the timing when the revenue is to be recognized in the books of the seller. The timing would be, the simple rule for that would be when you transfer the ownership or when the goods are transferred and its related risks as well as rewards are transferred to the buyer. Then only we would be considering that to be a sale or the revenue is recognized. Then let's talk about the accrual principle. Accrual principle says we need to recognize the revenue and expenses. Both revenue and expenses are recognized when they are earned or incurred, which means the actual outflow or inflow of cash is not important here. It would be the timing when it becomes due. Whether paid or payable hardly makes any difference, right? Let's see by way of an example. How to record the revenue? Say for example, XYZ Corporation provides consultancy services in the month of March, but the client pays for the services in the month of April. We know that our accounting year starts from 1st of April and ends on 31st of March. This service has been provided in this year. Suppose this is 2023. But the payment is made in the next financial year, which is 2024. Why? Because it starts from 1st of April 23 and ends on 31st of March 24. This starts on 1st of April 22 and ends on 31st of March 23. So this would be termed as the revenue for the year 2022 and 23 because it has happened in the month of March. The moment you provide the consultancy service, you have a right to claim that money from the client. The amount paid has been in the next month, but it would not make any difference for us. So the accrual principle says, in this case, we would deem this to be our income in the month of March itself, not in the month of April when the payment is made. Similarly, if we talk about the expenses, when the expenses needs to be recorded. Say for example, if there is a company called ABC Corporation which incurs utility expense of 1000 in the month of March, but the payment is received or it is paid in the month of April. Again, this was about the income and this is about the expense. So we have taken an example for both of these. In case of expense, if you have taken the benefit in the month of March itself, but you have paid in the month of April, then you will treat this as an expense for the month of March only, not in the month of April. Which means the payment or receipt of cash has nothing to do with this principle. It says whenever the amount becomes due to be received or paid, you need to show that in your books of accounts, right? Now, we need to compare this with the cash basis, because in accrual cash has nothing, no role to play, but in cash basis of accounting it says you need to record only when cash is received or when cash is paid. These are two ways of accounting: accrual basis of accounting and cash basis of accounting. Let's see what is the difference between these two. In case of accrual basis, we say that the revenue has been recorded. The revenue is recorded when it is earned. Nothing to do with the cash received or cash paid. In case of cash basis, we would record this transaction only when the cash has been collected. In case of expense, we would say whenever it becomes due or whenever the benefit has been taken. But in case of cash basis, we would say it would be recorded only when the cash is paid. Right? GAAP compliance, this complies the GAAP rules which says the amount needs to be recorded whenever it becomes due. But here it does not comply with the GAAP rules, because it says that the amount needs to be recorded only when it is paid in actual. Let us see this by way of an example. Say for example, if you are staying in a hostel, when do you think that the owner of this hostel would record his income as received or receivable? When do you think he would record his income or expense? Recording of income happens at the end of the month, when the day when your rent becomes due. You stay there for a month, which means the rent becomes due for him. Similarly, whenever he whenever he has to pay the wages for maintenance of that room, that is the time when he would be recording his expenses. Whether it has been paid or not would not make any difference. Whereas in case of cash, if we talk about the same example, the person who is maintaining his books of accounts on basis of cash would record the income only when it is received by the student. Also, the expense would be recorded only when it is paid by the owner. Right? So there is a big difference between the accrual and the cash basis of accounting. Accrual says whenever the amount becomes due to be received or to be paid, then we need to record that. Whereas cash basis says it would be recorded only when the cash has been actually received or paid. Clear? Then we talk about the accounting period concept. What does accounting period concept says? We have already discussed this earlier. We say that there is a concept called as going concern concept, which says that the life of the organization is assumed to be infinite. But we cannot delay or we cannot postpone our results to that period. So we need to break this total life of this organization into few periods. Each period comprises of 12 months starting on 1st of April and ending on 31st of March the next year. Right? So this accounting period concept says you need to record the transactions related to every accounting period, which is for a period of 12 months. Right? And the realization and accrual principles are both to be applied in the context of this accounting period. Whether we talk of the realization principle or the accrual principle, these would be applicable for this particular accounting period. And how does this relate with each other? Whenever we prepare the balance sheet, it is prepared at time zero. which means balance sheet, we have known that balance sheet is nothing but a snapshot of all the transaction as on the end of a particular year. So this would be the opening balance sheet, and the next period of the balance sheet, which is T1, this would be again on 31st of March. Suppose if this is on 31st of March 22, this would be on 31st of March 23. So from 1st April 22 to 31st of March 23, whatever transactions happen, these are recorded in the profit and loss account. Then on 31st of March, you have a balance sheet, which would be the balance sheet at the end of year 1. Similarly, the balance sheet at the end of year 2, and the timing between these two would be the period wherein we record the transactions related to profit and loss account, right? So the accounting period says that you need to make the transactions for P&L account for the complete accounting period, which is of 12 months starting on 1st of April and ending on 31st of March. Then you have this matching concept, which says you need to match the revenues of a period with the expenses of the same period. This is matching concept. All you need to do this only. Same period, that's it. You need to match the revenues of a particular period with the expenses of the same period, right? Say for example, if a bakery guy buys ingredients in the month of March for 20,000. There was no sale in the month of March. So we would not recognize this as an expense in the month of March. We would not do this. In April, he sells 100 cakes for rupees 500 each, earning 50,000 as a revenue. Then we would say the revenue for April is 50,000 and the corresponding expense for the month of April would be 20,000. We would not say this expense to be related to the month of March. We would say this expense is for the year of, for the month of April. Why? Because the matching concept says whatever the period of revenue is, you need to match the expense related to making that revenue happen. So that is the matching concept. Herein we have purchased the goods in the month of March, but we do not record that in the month of March. What we do is we record that as an expense in the month of April, right? Let's summarize whatever we have discussed. We talked about the principles. The first principle was the realization principle, which says that time or the point of time when the revenue is said to be recognized would be when the ownership is transferred, transfer of ownership. Means transfer of risks and rewards related to that product or service. Whenever it is transferred, we say the income has been recognized. Then we talk about the accrual principle, which says you need to record the transactions when it becomes due, not when actually paid or received. Right? The next principle was the cash basis versus accrual basis. We talked about cash basis versus accrual basis, which says in cash basis you record the transaction only when the actual cash is received or paid, whereas in case of accrual it becomes we record the transactions based upon when the amount is due. Accounting period concept says you need to prepare the records for a period of 12 months, which is the accounting period. Matching concept says you need to match the income for a period with the expense of the same period. Then only you get the profit or loss for the same period. So these are the principles which we discussed in this video. Thank you so much and bye.